Dear class, today let us continue with our session number 9, and this will involve an introduction to partnership. As the business grow, it becomes more difficult for one person to provide capital and manage its affairs effectively. And therefore, there is a need to combine effort and the capital from another person. So this gives rise to a partnership form of business. By partnership is formed by agreement. It is not necessary that the agreement should be in writing. It may be oral, but to avoid a future dispute, it is always better to have it in writing. A document in writing that contains an agreement of partners is called the partnership deed. Usually contain the undermentioned information: name of the firm, name of partners, nature and the place of the business of the firm, date of commencement of partnership, duration of the firm, capital contributed by each partner, rule regarding operation of the bank accounts, a ratio in which profit and losses are to be shared, how the business is to be managed, rule to be followed on admission, retirement, or in case there is a death of partners. Salaries payable to partner, interest on capital, loan or drawing to be allowed or charged, settlement of account or dissolution of the firm, arbitration clause, that is the process of resolving dispute outside the. So, for instance, let us have illustration number 1 to see how two independent businesses can be combined to form a partnership. For instance, assume that AROF and the T-Share combine their proprietorship to start a partnership named the US Software on 1st January 2021. So the firm will specialize in developing financial modeling software package. ROF and the share have the following asset prior to the formation of partnership. So show the entries and statement of financial position. We have a book value for AROF and the T-Share. We have a cash assets, which is for T-ROF 8,000, T-Share 9,000. And again, office equipment 5,000 with accumulated depreciation of 2,000. Account receivable for T-Share the 4,000 with its allowance for doubtful debts of 700. So market values for assets that are owned by both parties. Cash is 8,000 plus 9,000 is about 17. Office equipment, they agreed on values, market value to be 4,000. And the also account receivable remain the same, but also it is provision for doubtful debts increased from 700 to 1,000. So this will give us a journal entry. We have to debit all assets, banking 17, office equipment 4,000, account receivable 4,000, and with the ROFE capital and the T-share capital of 12,000 each. The allowance for doubtful debt of 1,000 is shown on statement of financial position. Assets, we have a cash in bank, account receivable, allowance to doubtful debts, and the office equipment of 4,000. So this gives us 24,000, which are equivalent to the capital of ROFE and the share of 12,000 each. Situation number 2, we have a Kelvin and Julia agree to join their business to form Julian and the company partnership. The statement of financial position for each business as at 1st January 2023, the time of the agreement were as follows. We have asset and the liability for Kevin. Kevin has bank balance of 3,000, account receivable 2,600, and then a building of 140,000. Together with the liability of account payable of 4,000 and the loan long-term 40,000. So give us 44,000 liabilities, which give a rise to capital of Kevin to be 101,600. But Julie also has inventory and plant 40,000, motor vehicle 28,000, land in the building 44,000. That gives us a total asset of 112,000. The liability of a bank overdraft of 4,000. So they make agreement. Kevin and Julie agree that Kelvin asset and liability will be taken over at the book value except the account receivable expected to realize only at 2,200. But again, land and the building to be valued at 150,000. So Julia asset and liability to be taken over at the book value except the inventory to be valued at 36,000. The bank overdraft will be paid by Julia prior to entry into the partnership. So in addition, the agreed value of Kelvin business was value is 120,000. The Julia business was valued 116,000. So required, prepare general journal entries to record the information of the partnership and the statement of financial position of Julia and the company new partner. So this is the general journal that we have to debit assets and the credit liabilities. But again, the value of the business of each partner, you need to add assets is equal to capital plus liabilities. So the value of the bank will be 3,000, account receivable 2,200. Land in the building, we combine both of them to be 194,000. Kelvin goodwill will be 8,800. Inventory of plant 36,000. Motor vehicle 28,000. So Julia goodwill also will be 8,000. So this gives us account payable of 4,000. Loan long term 40,000 and Kelvin capital 120 and the Julia capital 116,000. So this will be shown in the Julia and the company partnership statement of financial position as at 1st January. Assets and the liability will be shown with the cash in bank 3,000, account receivable 2,200, land in the building 194,000, inventory plant 36,000, motor vehicle 28,000, goodwill for Kelvin and Julia 880, and account payable 4,000, loan long term with the agreed capital for each of them to be Kelvin 120, Julia 116,000. And this is the end of the presentation. Thank you very much.